Welcome to Market Catalyst. I'm Allie Canal. We're 30 minutes into U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, gold continuing its record run as investors flock to safety, how you can fit it into your portfolio. Plus, consumers under pressure, what it means heading into the critical holiday shopping season. And we're breaking down today's top analyst calls on Wall Street. First, taking a look at the major averages here, and what an interesting morning. We are now positive in the Dow, up just around 70 points. The NASDAQ also flipping into the green. We are still pretty much flat on the day, but we were much lower in futures trading, and the S&P is now down roughly 0.1%. But this comes after President Trump made more positive comments on U.S.-China trade relations, saying that his proposed 100% tariff on China was not sustainable. So that led to more risk-on sentiment in the market after we saw the regional banks spook the broader index. So you're looking at regional banks now on an intraday basis, again, climbing back from many of those losses. There were more concerns over fraudulent loans, private credit pressures. You're seeing Zion, which is one of the banks in question, now up over 5% on the day. But I want to take a look at a two-day here, and you're going to see a sea of red. So that just illustrates how deep this sell-off was on Thursday. But again, as risk-on appetite returns to the market, we are seeing that reflected in not only the major indexes, but also the bond market as well. So let's take a look at the 10-year yield. We were firmly below 4%. Now we are hovering at that 4% level. We are up around 2 basis points. Same here with the 30-year yield hovering at 4.6%. You're also seeing gold give up a little bit of those gains here, maybe hitting some resistance. We are trading at just around $4,300 an ounce. We did hit a record intraday high. We'll see how we continue to track as investors really seek some hedging against all of this volatility. And speaking of volatility, I want to take a look at the VIX, because the VIX has been on the move amid all of these unknowns on the policy front, along with the trade front. And if we take a look over the past 9 months, you'll see that the VIX was trading at its highest level since the April Liberation Day tariff announcements. Of course, we are nowhere near what we saw in April, but just goes to show that with markets at or near record highs, there's a lot more vulnerability here. But let's stick on the topic of the regional banks, because U.S. bank stocks shed more than $100 billion in market value on Thursday after regional banks Zions and Western Alliance reported losses due to alleged fraudulent loans. It follows the bankruptcy of auto lender Tricolor and has sparked concerns of a broader credit crisis looming. JPMorgan Chase CEO Jamie Dimon saying, quote, "When you see one cockroach, there are probably more." I want to bring in Mark Zandi, Moody's Analytics chief economist. Mark, great day to have you. I just want to get your reaction to what we saw over the past 24 hours. It seems like contagion is not there. It's relatively contained. But are you concerned that this could trickle through into the broader economy? And do you see any resemblance to what we saw in 2023 with SVB?
No, Allie, not yet. I don't sense any kind of systemic problem in the banking system among the regional banks. I mean, the fundamental business appears to be good. Loan growth is kind of mid-single digit. That's kind of right where you'd want to see it. Credit quality broadly is good. Yeah, there's some pockets of weakness in consumer finance, auto, subprime auto would be a good case in point. But broadly, credit quality, delinquency rates are good. The net interest margins are improving. That goes to the Fed's easing of monetary policy. Short-term rates are coming down relative to long-term rates at which banks lend against. So you kind of add it all up. And of course, the banking system feels well capitalized to me. Underwriting has been tighter since the 2023 banking crisis, and that's all good. So no, I don't sense anything untoward here, at least in a broad sense. I'm sure there's other idiosyncratic problems that will come to the fore, but they always come to the fore. So no, not at this point. No, I'm not overly concerned about it.
So more idiosyncratic in nature, not necessarily systemic. I guess right. With the Fed expected to meet next week, I'm sure Jerome Powell is going to be asked about this. Do you think there needs to be more oversight for some of these banks?
I think they get plenty of oversight. I mean, mistakes were made, obviously. I mean, the 2023 banking crisis was a mistake, a regulatory mistake. Didn't catch the problems that were evident as SVB and some of the other banking institutions that got caught up in that crisis. So yeah, mistakes were made, but I don't sense that the regulatory oversight is lacking any meaningful way. Something could pop up here that I'm just not expecting, and there are things to watch, no doubt about it. I mean, I heard you mentioned private credit. That's something that needs to be carefully considered. It's a much more opaque market. It's not transparent. Don't have as much information as we do for the banking system, so we need to watch it. It's been growing obviously very quickly. So there are some things to keep an eye on and to watch, but from my perch, I don't see any kind of regulatory failure here or any lacking of regulatory oversight, at least not at this point.
And beyond the banks, one of the reasons why we're seeing a lift in the overall market today is because trade is back in the headlines and President Trump speaking more optimistically about those negotiations with China. And you recently wrote that last week's $2 trillion sell-off was a reminder of how vulnerable these juiced up markets are today. When you look at the trade landscape, I guess how much of a swing factor is that when we look at the overall economy, considering it seems like tariffs, they haven't really filtered through into consumer prices in the way that we maybe initially feared?
Yeah, so I'm more sanguine about the banking system. I'm less sanguine about financial markets. I mean, valuations are high, and you can see it in the equity market, you can see it in the corporate bond market, obviously the crypto markets, commodity markets, gold prices. Everything feels a bit juiced, overvalued, bordering on frothy. And a lot of that's it's not the tariffs aren't the issue there. It's more the just a run up related to artificial intelligence and the euphoria over that. And it's not like these aren't real companies they're juggernauts, but it just feels like investors have discounted all of that and then some. And when that happens, the markets are prone to correction. And because the surge in stock prices is so key to the well-to-do who are driving consumer spending. They're focused on their stock portfolios. One reason why the economy is holding up as well as it is in the face of those tariffs is all the consumer spending related to the surge in stock values and the wealth effects. If that gets turned into reverse and we see stock prices decline, then that's the real threat to the economy in my mind.
Yeah, and what happens if those stock gains unwind? I guess where would we start to see that first?
Well, I think consumers would respond. I mean, the well-to-do. I mean, here's a stat that I think is very telling. The folks in the top 10% of the income distribution account for 50%, almost 50%. This is my calculation. 50% of the spending, the consumer spending. So they drive the train, the economic train, and those folks, they're focused on their stock portfolios. That's where the stock ownership is concentrated. And so and right now they're feeling great. The valuation of all stocks outstanding is up $9 trillion over the past year, almost exclusively in those AI stocks. But if that goes into reverse and people see red on the screen, not green on the screen, and their nest eggs are diminishing, not getting bigger, then I think they pull back and the economy's got a problem. So that in my mind, of all these risks that are out there that we're thinking about, what's going on in the banking system, the government shutdown and everything else, that's the one risk that kind of is at the top of my list of worries.
Yeah, and when I think of the consumer, I think of the housing market. And some folks have told me if you just look exclusively at the housing market, that is signaling some sort of a recession. So how do you square what we're seeing with housing and then the overall resilience of the economy and the stock market too?
Well, Allie, it's like we got this pitch battle going on between these two very significant broad forces. One is the kind of deglobalization that's going on. That goes to the tariffs, that goes to the immigration policy. That's a powerful headwind to the economy, and that's why recession risks are as high as they are. And on the other side, the tailwind is AI, and we just talked about it in the context of stock prices and consumer spending, but it's also evident in investment spending, data centers, and electric power, and all that kind of things. So those two things are battling each other out, and kind of housing's caught in between. And you're right, when housing goes south, particularly in terms of construction, that historically has been a tell that the economy's headed to a recession. And right now, that's saying, hey, we got a problem. The economy is very vulnerable. Building permits are down. Construction is headed lower. So in that battle, which way this goes right now, the building permits, the housing numbers would suggest that, it suggests the economy is going to be soft here, maybe even potentially a recession. That in that in that that in the battle between the headwinds and the tailwinds.
And finally, the Fed does meet next week. We were just talking about all of the uncertainties that are around this economy at the current moment. And we heard from several Fed officials this week, and it seems like a December cut may not necessarily be a done deal. When you read through the tea leaves of all of this, how do you think the Fed is sort of looking at all this uncertainty as it weighs the next two interest rate decisions?
Yeah, I think they're going to cut. Particularly in the context of no data. If the government remains shut down, they're just not going to have any data. And I think they're going to err on the side of focusing on growth. That in fact, the risks to the economy, as I just articulated, are to the downside here. Recession risks are awfully high, and that they will continue to push rates lower. In part because that's, I think, appropriate in terms of this balance between their focus on growth and inflation. In part because of, I think they're nervous about their own independence, and if they don't cut and the economy does go into recession, they will get blamed, and that will really impair their independence even further. So I think they're going to err on the side of cutting rates. So I would be surprised at this point if they did not follow through and continue to cut interest rates.
Yeah, and that is interesting, Mark, because there's, I guess, a flip side to that argument where if they do cut, maybe they are catering to this administration.
Well, yeah. I think that's entering into the decision-making process. The administration is making it quite clear they want lower interest rates, and the Federal Reserve is, it's a political animal at the end of the day, and it wants to preserve its independence, so it's going to do what's necessary to do that. And I think that, all else being equal, argues for continued lower interest rates.
Yeah, and we have seen that weakness in the labor market as well, which Jerome Powell has consistently said.
Yep.
Mark Zandi, always great to talk to you. Thank you so much. Appreciate it.
Thanks, Allie. Take care.
You too. Well, coming up, we dig further into what's driving the bifurcation in consumer spending. That's next on Market Catalysts. Discretionary spending slowed in September, according to credit and debit card data compiled by Bloomberg. The weakness is coming from lower income households who are feeling the pressure of sticky inflation and softer wage gains. Meanwhile, higher income consumers are still opening their wallets. American Express reported card member spending up 9% last quarter, driven by its wealthier customer base. Joining me now to talk about this bifurcation in consumer spending is Deborah Weinswig, founder and CEO of Coresight Research. So, Deborah, I guess, how would you describe the state of the U.S. consumer right now, especially as we keep hearing about this bifurcation? And it feels like this moment of, okay, what happens when the rubber meets the road here and those higher income earners stop spending?
Yeah, first of all, thank you for having me on the show. Secondly, to just kind of contextualize, at Coresight Research, starting January of 2020, we've started to do a weekly survey of the US and the Chinese consumer. And so we have a lot of high frequency data that has helped us understand and really see significant changes between, and we break it into three different tiers. So 50 and under, 50,000 household income and under, 50 to 100, and 100 and over. And what we've seen throughout this year has been fascinating, where we've seen the bifurcation at really the highest that we've seen it since January of 20. And that's evidenced in the lower income consumer visiting more outlets per visit, if you will, or per purpose. So when they're buying groceries, they used to visit 3 different grocers or outlets. Now they're visiting 5 to 6. And this is about looking at the best deal, prices, coupon stacking, promotions. And so I think that there is a lot on their shoulders, and it's only getting greater.
So how concerned are you, considering you have all that data, and how unprecedented is this, I guess, compared to what we saw around the pandemic?
It's pretty, well, during the pandemic, right? We were really kind of catalyzing and igniting the economy around all kind of demographics. And so I think in this one, there's real concerns around inflation. And if you think about what people are buying every day, the average consumer goes to the grocery store or buys groceries 2.1 times per week. So they know the prices of those items. So if you think of it when we had like eggflation, right? We really saw people pull back. But if you start to think about what's happening on kind of greater grocery, it's throughout the store. And so I think this idea of, right, people are like, I see this and I see that, they're starting to pull back. The positive to this, though, is that we think holiday got pulled earlier, so that while right now I think we're in a bit of a kind of, let's just say a bit of a data sphere that we haven't been in before and trying to kind of understand the bits and pieces, it does look like the US consumer as a whole pulled spending earlier. But on the flip side, the high-end consumer right now is still very strong and stronger than we would have even expected. I think that goes to, there is confidence in this administration, and they're spending at levels, once again, we're seeing expectations are increasing in like August, September, and October. That at that level, it's unprecedented.
So in that sense, when you talk about tariffs, and we've seen a lot of companies absorb a lot of these costs, they haven't necessarily passed those costs onto the consumer at the rates that we were worried about when the tariff announcements were first made in April. Because those higher income consumers are still spending, does that give these retailers maybe more wiggle room that they can raise prices?
Oh, that is the best, that very few people have asked that question. I think that's a great one. Because I do think that, and especially if you're, let's say, a multi-brand department store or multi-brand kind of specialty retailer where you have, right, different outlets. The Gap is a great example, right? So Old Navy, Gap, Banana, right? You're really kind of appeal to different demographics across the board. That gives you more wiggle room. And I think as a retailer, not only do you feel more confident in your capabilities, but shareholders do as well, right? Your employees do as well. And so I think that we're going to start to see not only bifurcation of the consumer, but also in some of these stocks.
Interesting. And you also wrote in your notes that retailers should be visible on ChatGPT. So how big of a shift are you seeing when it comes to discretionary spending online and how a lot of these chatbots and AI at large is impacting those shopping behaviors for consumers?
It is greater than we would have expected. So we're moving to this era, right? You had SEO, now GEO and AEO. And so this idea of moving from very simple, right, kind of search engine optimization to looking at, the GEO and AEO being agentic. And so what we've seen with, even ourselves is that, right, we're showing up, right, as we're investing more in GEO, that when customers also come to us, they're there to buy because they've already done all of their research. And that's what we're starting to see with a lot of retailers as well. It's fascinating, and it really condenses the customer journey. So the consumer, when they are then at your store, right? And over 80% of Gen Zers, the store is a part of their trip. So one of the reasons we're also seeing more trips to physical retail. And that is really leading to much greater, first of all, many fewer returns, which is great for retail, which has over 40% retail return rate. We're seeing much more kind of consumer intention and, this right, condensing of the consumer journey. And third, as it goes into the holiday, right, I think that right now retailers are in control of their own destiny, unlike any time we've ever seen, because it's just about rethinking your customer journey. How are they going to find you? What demographic are they? And what do you need to do from a promotion and pricing perspective to get them to cross the finish line?
So given that, and along with your earlier comments, how we're going to see this bifurcation in some of these consumer-focused stocks names, what companies then are best positioned within this environment?
It's hard not to lean into. First of all, Walmart, I think, has surprised us on every level, right? Their greatest growth has been the over 100,000 household income, but yet they still have huge appeal with the value customer. I think the dollar stores, right there, there's been a lot of transition in that industry. I think kind of now is their time. Costco, BJ's, Sam's Club, right? The warehouse clubs, and you think about from the clubs, they have community and they have unbelievable amounts of customer data. So they're really able to, right, as we're starting to lean more and more into the chat GPTs and we'll just call it generative AI, they're able to really understand their customer even better. And then you've got, right, the TJ Maxx's, the Ross Stores, the Burlington. So I think this whole, at Coresight, we've had this kind of hourglass over time, and this middle being really squeezed, which we continue to see. And those value-oriented retailers on the bottom and those, true luxury brands on the top, that's where we continue to see a lot of, strength to strength, really. And I think that one other thing I think is incredibly important in this Gen AI era, we are seeing retailers and brands share information about how to do things, processes, in a way that we've never seen before because everyone is on their own path. And so the ability for retail, the ability to invest in retail as well and brands, I would say that the returns are going to be much higher because they're able to really kind of shrink the time to make decisions, investments, and ultimately outcomes. And so I think this holiday season is going to be unprecedented in retail. And I think going back to this bifurcation, not only the consumer of the stocks, I think is going to be much greater than what we've seen in the past too.
Yeah, it certainly feels like we're at an inflection point. Deborah, thank you so much for those insights. Appreciate it.
Thank you.
Well, home builder confidence getting a boost as future sales expectations jump in October. Yahoo Finance's Josh Lipton spoke to National Association of Home Builders CEO Jim Tobin about the state of the housing market. Take a listen.
So let's talk about these numbers. So builder sentiment, it did rise here, better than expected. 37, Jim. So we're below that 50 mark there. Future sales expectations did surpass 50. I just want to, maybe help me walk through these numbers and the trends. I did see, bottom line, your chairman saying here, the market remains challenging. Is that how you see it, Jim?
I do. I think the market is extraordinarily challenging at the moment. But the good news is that forward-looking sentiment, I think there's a real optimism with the builders right now about what the next 6 months are going to hold. I think that has a lot to do with interest rates coming down over the last month and mortgage rates in particular. The Federal Reserve lowering rates with the prospect of maybe one, if not two more cuts coming before the end of the year signals some reason to be optimistic about where the housing market is settled. That said, mortgage rates are still a long way from what hopefully is the new normal, somewhere inside that 5% handle. So we've got some challenging times ahead with buyers trying to get off the market, get into the market, get off the sidelines. So I think we still have some bumpy roads ahead.
Jim, the 30-year fix, according to Mortgage News Daily, I'm just looking here, 623. You've got economists on staff there, Jim. Where do they see that headed from here? 12 months from now, what are they telling you?
I think for over the next 12 months, we're going to be probably about the same place we are now. Just given that we still have some economic uncertainty out there, where the Federal Reserve takes us, does unemployment rebound? Does inflation stay, on that downward trend, or at least stay, kind of firmly in that 2% range? That's the real challenge in front of us. But I think the mortgage rates are going to trade in a kind of a narrow band between 6 and 6.5 between now and the end of the year. We really don't predict kind of consistently into that 5% range really until we get into 2027.
What have we been seeing with pricing, Jim?
A lot of discounts being offered by builders to move product. As builders stay on the sideline, there's a lot of reports that out there that this is a buyer's market. We are seeing that deep discounts are the order of the day. Some mortgage rate buy downs, but we're hearing that price reductions in the home itself is really what's moving the market in the areas that it can.
When you're talking to builders, Jim, across the country, I'm curious, and maybe you ask them, hey, what are your most significant challenges right now? What are your most significant headwinds? Are there certain themes, Jim, they bring up? Is it labor? Is it materials? Is it red tape? What do they tell you?
Yeah, I as you know, Josh, I travel all over the country. I've been in Iowa, Oklahoma. I'm currently out in the Pacific Northwest now. So I talk to builders all over the country. Consistently, it's about high mortgage rates, getting buyers off the market, and it really still always comes down to the red tape at the local level. What barriers are local governments and NIMBYs putting in the way of builders to build more supply right now? So again, interest rates, but then that local the delays and costs it takes to build homes in this country, it doesn't matter what market you're in, continue to be one of the chief complaints of builders.
Does the federal government, Jim, have a role there to play?
Absolutely. I think the federal government, they are part of the regulatory regime. You've heard me say this before on your show. 24% of the cost of a home in this country is embedded in the regulatory burdens at local, state, and the federal level. So the federal government does have a role to play. Certainly, we talk to President Trump, his White House, as well as his departments and agencies all the time about some of the deregulatory actions that he can take to lower the cost of land development and construction in this country. And then what are the levers that the federal government can use to put the onus back on local governments to remove those barriers to housing production in the country. And so we're expecting some action with the administration. There's a bill working its way through Congress. The road to housing right now, it's moving through the Senate. The House is going to act. So housing is having this moment, and we've got to translate that kind of political moment into a policy moment in the country.
Now, Jim, you mentioned President Trump there. You saw his comments calling on Fannie and Freddie to boost home building. What did you make of that?
Well, we share the president's absolute desire to increase the housing supply by building more housing in this country. Certainly, Director Pulte shares that view. We've talked to them consistently, not only since the president tweeted about a week and a half ago, but since the director was confirmed and the president came in January. So I believe that there is a role for Fannie and Freddie. Obviously, they do a great job on the mortgage side. But if we can hold the feet to the fire of local governments and work on regulation to, again, get those barriers out of the way, what role can Fannie and Freddie play as far as when it comes to construction lending? We continue to talk about a way that they might be able to do that. But what we really need to do is make sure that everybody, all the builders out there, all we want to do is build housing. We want government to be a partner and not a hindrance. And so when I hear the president and Director Pulte talking about building more housing, that is music to my ears, and we are ready to go.
Welcome back to Yahoo Finance. I'm Brook DiPalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. First up, we have AMD. Bank of America raised its price target on the stock to $300. Its previous price target was $250. The analyst said it now sees greater visibility into the launch of its AI hardware platform, supported by key customers like Oracle, Meta, and OpenAI. There are currently 48 buy ratings, 16 holds, and 1 sell in the street for AMD. Next up, American mining company Freeport McMoran. HSBC upgraded the stock to buy from hold. The firm also raised its price target to $50, citing that the company could benefit from the price levels we're seeing in the gold markets and other precious metals. Freeport McMoran is also set to release earnings next week on October 23rd before market open. And lastly, space technology company Intuitive Machines. Deutsche Bank upgraded the stock to buy from hold this morning. The analyst said that it sees the company as a secular winner in the space exploration market, helping the U.S. and its allies prep for more humans to go to the moon. He also said the stock has underperformed its new space peers since February, trading at a discount compared to Rocket Lab and Firefly. The stock is still down roughly 30% year to date and now trading around $12 a share, but the average price target on the street currently stands at $15. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We're watching Micron, crypto stocks, and Apple. First up, Micron exiting the server chips business in China. According to a report from Reuters, the company will stop supplying those chips to Chinese data centers. It comes after Micron faced a ban from Beijing on the use of its products in critical infrastructure. The company will still continue to sell chips to auto and smartphone customers in the country. Next up, crypto stocks falling as Bitcoin plunges, the largest cryptocurrency hitting its lowest level since June as investors pile into physical gold over digital gold. Finally, Apple signing an exclusive 5-year deal to be the broadcaster of Formula One. The deal will bring every F1 race to Apple TV starting in 2026. Coverage will be included in the streamer's monthly subscription. It comes after Apple worked with F1 on F1 the movie earlier this year. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, all your market action straight ahead. Stay tuned. You're watching Market Catalysts. Big food.
feeling the pressure as consumers push back on higher prices, forcing names in the space to roll back price hikes. We're navigating how to play the sector with the Yahoo Finance playbook. And joining me now is Robert Moscow, Managing Director at TD Cowen. Robert, it's good to see you. So one trend that's interesting, Robert, in your universe, these food companies, years of price hikes, Robert, and now we do see some recalibration there. Just talk to us about that trend, Robert, and where you think we are in sort of the adjustment cycle there.
Well, I totally agree. There has been recalibration. Some companies more than others. General Mills is probably rolling back prices 3 to 4%. I think more companies are going to have to do this. Like Frito-Lay in salty snacks probably hasn't done it enough to re-engage consumers. So, and it's not an easy road either. When you lower your prices, you don't necessarily get the snapback in volume that you would expect. So these food companies are kind of in between a rock and a hard place. They want to improve affordability, knowing that the volume is not going to come back all at once. But I think it's really important to do it in order to foster a better value proposition for consumers going forward. Against
that backdrop, Robert, are there certain names that you cover that you think, okay, these names are relatively well positioned to win back volume, but not negatively impact margins?
Yeah, I have a buy on McCormick. It's the leader in spice and seasonings here in the U.S., leader in flavorings, also globally. The stock hasn't really worked this year. And I think part of the issue is tariffs. Tariffs are up, probably hitting their P&L by $120 million this year. They've been very, very careful not to raise prices too high and ruin their value proposition by trying to price all of this inflation right away. But as a result, and volumes are positive as a result. I think heading into next year, though, there might be some latent pricing power on this business. They've got they're in categories where consumers really need spice and seasonings. They're shopping more in the perimeter of the store, more fresh food. They're creating their own recipes. They're trying to save money and they're trying to eat healthier. And frankly, I think consumers don't really remember what they paid for like a vial of oregano from 1 month to another. So I think there's some latent pricing power here. If they're able to untap it, I think there's positive revisions to earnings estimates.
There was news today, Robert, I wanted your take on as well. I'm sure you saw this headline, Nestle slashing 16,000 jobs. I know you don't cover that name. I am just curious though, Robert, do you think is that another trend to watch in your space?
I think it's already happening to some degree. We're seeing restructuring programs go into place. I've seen it at Procter & Gamble. I've seen it at Colgate and a little bit at General Mills as well. And I think even at PepsiCo as well. So I think that all depends on the degree to which companies need to scale back their organizations in sync with the volume fall off, and some are going to be some are better positioned than others.
Robert, we're always looking for lines of sight into the consumer. I'm curious, based on your coverage universe, what you're seeing and hearing. How does the consumer look to you?
Challenged. There's a lot of value-seeking behavior across the grocery store. I think the biggest surprise is, you'd expect when the consumer's challenged that they might eat out less and eat at home more. That's happening to some degree, but the overall grocery sales are only up 2%. So it's not a windfall for vendors to the grocery store. I think also within processed foods, there's increased distrust of just processed foods in general because of the Make America Healthy Again initiative and other factors. So I think it's a very difficult playing field for processed foods companies right now.
You mentioned the MAHA trend. There's another trend too, Robert, the GLP-1s. The companies you cover, how have they been adapting their portfolios, adjusting to those new medicines?
Well, in snacking, I think it's a little difficult because some of these snacking categories are incrementally more impacted by GLP-1s than the other just conventional food. And that's because consumption is expandable. So if you're snacking 4 or 5 times a day, kind of mindlessly, and you're on GLP-1s, you're going to snack probably 4 or 5 times less per day. Whereas conventional meals, lunch, breakfast, and dinner, you'll probably continue to do that. So the snacking companies are working on portion sizes. The meal-based companies are trying to develop more protein-based solutions, solutions that are targeted directly to what GLP users are looking for. Frankly, the snacking companies are trying to do it as well. I think it's going to be more difficult for the snacking companies to adjust than for mealtime companies.
Robert, great to have you on the show today. Thanks so much.
Thank you.
Gold edging a bit lower this morning amid its recent record tear, up about 60% year to date. So how should investors think about adding gold to their portfolios in the midst of market volatility? Here with me is Lawrence Sprung, founder of Midland Financial and author of Financial Planning Made Personal, for this week's FA Corner, brought to you by Capital Group. So Larry, even though we're seeing gold pull back a bit, it's been consistently at record highs over and over again. When it comes to folks that are looking to add gold to their portfolio, how should they approach that? And is it just strictly a hedge, or is there something more strategic there no matter what market environment you're in?
Yeah, so I would say that it would have been great if they added it before it was up 60% probably and looking at it. But that's the thing. You want to create portfolios that are going to withstand long market cycles. So if you miss the game and you're looking to get into gold, there are a number of different ways to get in there. For retirement accounts, we talk about maybe more ETFs and mutual funds because they're easier to enter, less compliance. Outside, you could certainly buy physical gold, but at the same time, you have to be concerned about insuring the gold and physically storing it. There are other challenges there, but it's a place to enter, but enter cautiously. You're entering at a huge upside right now, so just be careful about that.
Yeah, I guess that's a question I had too. Is there a point in time where maybe it becomes a little too expensive to add gold to your portfolio?
Yeah, I think you have to be leery and go in cautiously for things that are up 60% in a given year. And if you look the past 3 years, we've had consistent double-digit growth, not as much as we've had this year. So you have to say, am I getting in at the right time? And maybe just enter with a partial position in terms of, if you're looking to add 1, 2, 3, 4, 5%, add a portion of that to your portfolio now, and then maybe look for a pullback. And if that happens, maybe use that as an opportunity to buy more.
And how should you approach adding gold to your just pure play investment portfolio as opposed to some of those retirement accounts that you were mentioning?
Yeah, so I think in your regular accounts, you can look at the ETFs and the mutual funds similarly. I think those are a lot easier for most investors to enter. You can, like I said, buy physical gold, but then you have to worry about storing it. You have to worry about insuring it. There might be other costs associated with it that you may not be aware of as you purchase those things.
And we've talked a lot about how gold's recent run-up has been due to the dollar coming down. How should folks be looking at maybe currency swings or other things happening in the market to reflect how their gold will perform?
I think gold really at its core is a hedge, right? It's a hedge against the dollar. It's also a hedge against currency concerns. It's also a hedge against political uncertainty. So there are a lot of these things. I don't know that it's just the dollar. I think there's a number of factors that people are feeling uncomfortable about that are driving the gold prices higher. If that continues, will that continue? Who knows? We'll see. But it's not a bad thing to have a 1 to 5% allocation to gold as part of your overall portfolio and strategy.
And what about other precious metals like silver, for example? That's been at record highs. What are the ways to get into silver? Is it similar to gold with ETFs?
Yeah, similarly, you can buy the physical, but you still have those same challenges that we mentioned with gold. But there are also other avenues to enter through ETFs and mutual funds. There are some that are just precious metal ETFs and mutual funds that really go into a broad band of different metals and not just gold.
And when you're looking for specific ETFs, is there a process that you should take as an investor to make sure you're getting the best ETF for you?
Yeah, I think
that's
all
the same.
They're very similar. You have to really understand what the underlying investments are, because they do have, by prospectus and by mandate, they can go in some different areas depending upon what that write-up looks like. So understand and know what you're buying within the ETF, and then secondarily look at the expenses associated with it, because at the end of the day, it's not what you make, it's what you keep, and you have to factor in the expenses and taxes into that equation.
And how does your positioning change depending on your age, your life cycle, whether you're a young person or someone that's about to retire? Should you be more exposed to gold if you're older?
Yeah, I don't know that it really swings that widely for young and old, because it's more of a hedge than, it's not something that's producing an income stream, right? When you start thinking about shifting portfolios like you're mentioning, you're talking about going younger, and as you get older, maybe you want some more stability, more income.
Right,
Gold
risk.
Gold doesn't produce the income stream, but it does mitigate a lot of the volatility. So, if you start out with a 5% position when you're younger and edge that up when you're older, that might make sense. But I think always getting that professional advice on what makes the most sense for you, if you don't have a good handle on it, is always a key factor.
Yeah, and gold is obviously one precious metal we're continuing to watch amid these record highs. But Larry, thank you so much. Appreciate you joining us in studio today. That was FA Corner, brought to you by Capital Group. Well, coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, we're watching the moves in crypto as Bitcoin drops below $106,000 a coin. Plus, CEO confidence is slipping and stagflation fears are growing. How America's top executives are weighing policy uncertainty. And consumers expected to spend 10% less this year, at least that's according to a Deloitte holiday retail survey. But first, we are 90 minutes into the start of U.S. trading. I'm Allie Canal. Let's get a quick check on the markets. Taking a look at the major averages here, and we're seeing stocks waver a bit. President Trump easing worries of a further escalation between U.S.-China trade, while regional bank stocks did begin to recover from significant losses amid some of those investor jitters over bad loans and U.S. credit quality. You are seeing the Dow up very marginally, really just hugging the flat line there. The S&P 500 is down roughly 0.2%, and the Nasdaq leading the way lower, down 0.3%. And Bitcoin falling to its lowest level since June as investors flock to safe havens like gold and treasuries. As a part of the flight to safety, investors withdrew a net of nearly $600 million from U.S.-listed Bitcoin and Ethereum ETFs. For more on what's next for crypto in this market, Nick Dukoff, Solana Foundation Head of Institutional Growth, joins me now on set. And Nick, let's just first start off with the moves that we're seeing, because October is typically a month where we see crypto perform well. Not the case this time around.
Listen, when there are shocks in the system, people sell what they've got a profit in, and crypto's up this year. And so I think this is just people taking profits, which is healthy. Okay,
profit taking. But there is this push to launch more crypto ETFs. We've seen various brokerage firms saying that this is something they want to do more of. But money flowing out of those ETFs, like we just said, is that a concern at all when it comes to supply and demand dynamics there?
I think year-to-date flows are certainly net positive, and I think you'll see them continue to grow over the next few years. The Solana ETF filings are obviously out. Fidelity, VanEck, Franklin Templeton, Bitwise, and others. And many have recently updated their S1s to include fees, which is usually the last step in the process. So hopefully more ETFs coming soon.
And explain to me the difference when it comes to Bitcoin, Ethereum. You were just talking about Solana. I feel like for early crypto adopters, maybe they're just concentrated on Bitcoin and Ethereum. Why should Solana maybe be part of the conversation?
Yeah, so the total industry market cap is somewhere around $3 trillion. Bitcoin being the dominant position in that. Ethereum being the second largest and Solana being right behind it. And so I think if you want to have a diversified portfolio, you probably want exposure to all of them. But the important thing to remember is what the differences are between Bitcoin, Ethereum, and Solana in terms of the asset as well as the technology. Bitcoin is typically seen as digital gold, Ethereum, digital oil, And Solana is the fastest growing technology platform in the world. And so if you want to think about having exposure to the Mag 7, which has driven a large part of the S&P's growth this year, you also want to include Solana because it should be part of that story with Meta, with Google, with OpenAI, with NVIDIA, and those types of companies.
And how can investors get exposure to Solana? Is it through those ETFs as well?
Soon. We've got a number of large asset managers, including Fidelity, have filed for Solana exchange traded products, and currently there's a government shutdown which has delayed the SEC approving some of these S1s, but I think you'll see them hopefully approved soon. There's also a large and growing number of DATs, digital asset treasury companies, similar to what Strategy has done for Bitcoin. There are now a number of these that are supporting the Solana ecosystem, including Forward Industries, which raised $1.65 billion a couple weeks ago.
So with these ETFs set to come down the pipeline, how is Solana really positioning itself to grab that investor attention?
Yeah, I think it's a really clear narrative, which is Solana's among the fastest growing technology companies in the world. And with staking, Solana also prints, a 7, 8, 9% yield by staking and generating the rewards from that.
And on a volatility basis, does that make Solana maybe less volatile to some of the moves that we see in crypto and Bitcoin, I guess, more generally?
Crypto is one of the most volatile asset classes out there. And I think folks that allocate to the asset class do it in part for the vol, right? You get the reward with the risk. And I think that's something that you want in a diversified portfolio.
And part of that volatility story has just been the embrace from the Trump administration, right? That's led to a lot of the gains that we've seen. So how has this administration really changed the trajectory for crypto?
It's been just such an enormous lift for the industry. Obviously, the executive branch has done a lot. We've seen administrative action from the SEC, CFTC, and other administrative agencies, but also, most importantly, you saw a legislative branch act with the Genius Act passing earlier this summer, and that has created an absolute groundswell of activity in the stablecoin space and more broadly in tokenization.
Yeah, you hear the word stablecoin and tokenization quite frequently from some of the biggest companies out there. And I guess, what more would you love to see on the regulatory front?
So the Clarity Act is another bill that's in Congress today, and I think that will help the markets understand, what is a commodity, what is a security, what are the registration processes, and how can the various ecosystem participants, what do they need to do to provide exposure to digital assets to the broader retail and institutional investor base.
And when we look at Bitcoin, Ethereum, Solana, do they often move in tandem with each other? And if you're an investor, do you want to be exposed to all three? Do you want to be concentrated in one?
So I don't know the latest correlations, but generally Bitcoin and Solana have a tighter correlation than Solana and Ethereum do.
All right, really interesting stuff. Nick, thank you so much. Appreciate it. We'll see what happens with the rest of these crypto moves, as it's often a volatile asset. Last week, we were just trading at record highs of Bitcoin. So you never know, but appreciate you joining us on set.
Thank you so much.
And all your market action is coming up straight ahead. Stay tuned. You're watching Market Catalysts. CEO confidence edging lower for the fourth quarter as business leaders navigate trade and tariff risks and an uncertain macroeconomic backdrop. That's according to the Conference Board. Joining me now to discuss this is Robert Glazer, Acceleration Partners CEO and author of the book, The Compass Within. Robert, thank you so much for being here.
Thanks for having me, Allie.
So we're seeing this lack of confidence from CEOs, and obviously there's a lot of uncertainties in this economy right now, but from where you sit, what's really driving some of this pessimism?
I think there's a lot of uncertainty, as you said. There's a lot of back and forth and whack-a-mole, and we still have some hangover from COVID. I think the ups, the downs, the left, the right, the too much inventory, not enough inventory. So I think it's been hard for people to get a steady state, and that makes decision-making hard.
And we have heard before that it's more so the unknowns that are the issue. It's better to just know everything that's going to happen. And as we've seen on the trade front, we don't necessarily even know what tariffs we're going to be putting on China at this point. So how much of that is a factor too? Yeah,
I think markets do not like unknowns. Everyone has a game plan A, a game plan B, and a game plan C, and that's just multivariant decision making, which makes anything harder.
And the Fed releasing its beige book and noted that layoffs are picking up, some tied to softer demand, others to AI investments reducing headcount. How are leaders striking that balance between efficiency and employee morale right now and making sure that they're not leaning into increased layoffs? Because you talked about PTSD from COVID, and that was something that I think business leaders today go back to because it's really hard to hire those workers back.
Yeah, and I think they're having a hard time, and this gets to the root of kind of understanding like what you value and how do you feel about a decision in a day, in a week, and in a year. There's a lot of pressure in this 24-hour news world we're in. Like, what's your answer today? What's your decision today? And you see people, as you said, laying off because of AI and then hiring them back and more chaos. So I think if people kind of slowed down a little bit and didn't try to win the day and maybe thought about how do I win the week or the month or ideally the next couple of years.
And how should CEOs be approaching that and doing that, especially since we are in the early innings of AI?
Look, I think you need to be clear about what it is that you value personally and in your company, and how does AI work itself into that? You know, you can't say we value X, Y, Z and people and their contributions and then automate everything. That just isn't consistent with what they're saying. So when I think about some CEOs that have made difficult decisions, they're decisions that like everyone said would cost them in the short run, and they were better in the long run.
And talking about better in the long run, one trend that I've noticed across industries, so look at Comcast, look at Oracle, Spotify, is this dual CEO structure. Not just one leader, but two leaders. What are the pros and cons of that approach?
Look, I think the job of a global CEO now is almost too big, right? It's a 24/7 job, and you have to be in these places, and so just the nature of it, not as many people maybe even want that job, as crazy as it sounds. So I can see how people want to break these up. I think it's really hard when you start splitting accountability for the most important job. I remember coaches usually say you could have a person in two boxes, but not two people in one. I think the people in the organization are looking to a single person to answer. So I would more see how to break that up in terms of a European CEO or a US CEO.
Clear
or
and
president.
obvious.
Clear and obvious distinctions. Like who am I talking to and who is the last word on this?
And it does seem like to a certain extent, those dual CEO structures, that is happening, right? For example, with Netflix, you have Greg Peters, who is firmly focused on the product side. Ted Sarandos is more on the content side. So it seems to be like more clarity over everything is important for leaders and also those who work under those companies.
I'm just curious if those companies have a crisis, who are people calling? And who are they looking for an answer to, right? It seems like those titles are almost maybe a little bit different, but it's tricky. And again, but these are hard jobs. And
just being in this industry, talking to the executives that you've spoken with, I guess, how have the issues that companies face changed over the years? And maybe how has the role of the CEO changed?
I think it is this 24/7 always on global. I think that's how it's changed. And I think it is the expectation that there is a response today, right? And a lot of times the answer today is really not the best answer, the right answer. It's hard to say, you know what, we don't know, we don't have all the information, we're gonna dig into that and make a better decision when everyone's kind of asking you for what's going on right now.
And your company, marketing consulting, right?
Yeah.
So we typically hear when there's an economic slowdown or recession, marketing budgets first to go. What are you seeing when it comes to marketing spend and how businesses are allocating their capital?
Yeah, marketing has had a tough couple years, and people are being more discerning. There's less venture capital, there's less money out there. People want to know where their money's going, how it's being spent. So there's definitely more belt tightening than there was a few years ago, but that forces you to sharpen your pens and make sure you're doing a good job, and it tends to favor the stronger players.
Okay, so you are seeing evidence of sort of that pullback or that just more cautious approach when it comes to allocation.
There is definitely not money being thrown around like it was pre-COVID.
All right, so a lot more uncertainty within this economy and for all these businesses. Robert, thank you so much. Appreciate it.
Thanks for having me.
Of course. Coming up, we get a check of the latest market action over at the NASDAQ, plus holiday spending trends. That's next on Catalysts.
Welcome back to Yahoo Finance. I'm Brook DiPalma, live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours in today's trading session. And what we're seeing is a reverse course, especially when it comes to the Dow. We did see some momentum at the open, but now we're seeing that pull back a bit. The Dow roughly flat 2 hours into the trading session, whereas the S&P 500 is down about 0.3% after gaining some momentum at the open, but the NASDAQ really leading the downward momentum here, down about 0.5% and really extending, down about 1% over the last 2 days. And if you take a look at what's dragging the NASDAQ lower, I want to take a look at semiconductor stocks, because right now we have a bit of a bleak picture here, but we are seeing a bit of an upside when it comes to Intel. We did hear that Intel's chip making business, its foundry business, has a large AI client. Now, we don't exactly know who that AI client is, but what we do know is that we haven't really heard of new customers in quite some time, and this is leading to just a bit of momentum from investors today. Their former announcements were around partnerships with Amazon and Microsoft, and they've been struggling to really tack on another big customer. So hearing that they have a large AI client certainly led to some momentum this morning. Now, on the flip side, McMoran is down about 3% as we make our way into today's trading session, and that's because Reuters actually reported that the chipmaker plans to stop supplying memory chips for servers to data centers in China. And so we're seeing that stock decline down about 3% today, but in the last 5 days, it has seen some momentum up around 8%. Once again, bleak picture when it comes to semiconductor stocks. But on the flip side, another thing that's been largely on investors' minds over the past few days is regional banks. And we're seeing a different picture there. We heard from some regional banks like Truist Financial, Huntington Bank Shares, and Fifth Third Bank Corp today. And that's where we're seeing some momentum get regained after concerns around bad loans and credit quality that really spooked investors on Thursday. We're seeing some renewed optimism here into today's trading session. Truist Financial up about 3%. We also have Huntington Bank Shares, that stock up about 0.3%. And also some of the biggest losers yesterday, including Zion Bank Corporation, seeing some momentum today, up about 2.5%. And also, if you take a look at equal weight here, we are seeing others within moving even higher too, up about 2.5%, 2.3%. We are seeing some moving lower though. But once again, taking a step back, all three major indices roughly flat as we make our way into the trading session midday today, but the NASDAQ really still holding on to that downward momentum, down about 0.5%. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Well, it's Watch Week in New York, bringing together enthusiasts and industry leaders. Yahoo Finance's Josh Lipton and Prosper Romanian spoke to Patrick Prunillo, chairman and CEO at Ulysse Nardin, about the luxury watch market. Take a watch.
Patrick, I'll start with you. So it's New York Watch Week. You just debuted a new watch. Walk us through it.
Yeah, we launched yesterday a new Freak. So the Freak is one of the iconic watch of the year.
The Freak?
Yeah, the Freak. That's how it's called.
Now, why the Freak, Patrick?
Because we reinvented the old watch 25 years ago. It's actually one of the watch that set the tone for contemporary watchmaking 25 years ago. And we launched a new one, double oscillator. So it's a mix of different technologies that are very unique. And it's probably the most complicated time-only watch in the world.
So Patrick, we're seeing the watch right now. I was enamored with the watch because of the fact that it has this movement that actually moves around the watch to tell us time, really a unique type of situation. But you guys took the time to reveal the watch in the U.S., right? And it's a global release, but in the U.S. is where you are right now for Watch Week. Talking about that U.S. market and why it's so important to your brand.
Well, it's our number one market, and it's very important for not only for Ulysse Nardin, but also for the watch industry. It's a very dynamic market. We've seen a growing number of watch collectors in the US, and this has been expanding, especially since COVID. The level of education on watches is tremendous here in the US, and there is a very strong appetite for independent brands, for brands that are not only mass luxury brands, and brands like Ulysse Nardin.
When you think about the luxury watch market right now, Patrick, broad strokes, you have great line of sight. How healthy, how strong and resilient does it feel to you?
First of all, when you look at that market, it's been growing significantly. The growth rate has been significant for a couple of decades now. And it continues, and I think it will continue. It will go through cycle.
Why are you so confident, Patrick?
Because I think the watch itself is an object which is extremely contemporary. You actually carry not only a piece of craftsmanship, but it's a mix of emotion and technical things that you can carry with you all over all the time, and its timelessness and the genuineness of our ideology timepiece is actually very, it's exactly what the consumer expects today. You can travel with it, you cannot travel with your car. So it brings you not only something you love, but also status at the same time, and it also shows who you are and what your tastes are.
So in the U.S. market, I got to bring up the T word, tariffs. This is your biggest market. You have a range of watches from a few $1,000s right up to a couple $100,000. Talk to us about the effect of tariffs on your business and what that can mean for a consumer. Like, how much are they going to pay more for a watch, let's say?
Well, let's say overall, first the company, Solana, has been existing for almost 2 centuries. So we've been, as you can guess, through many cycles, and obviously we've seen some tariffs that increase or decrease. So I don't think it's going to impact massively our business overall, not only Solana, but I think the watch industry. There could be actually some increase in a tariff, in price in the US, but actually the weakness of the dollar has probably as much impact as a tariff on the price you have here in the US.
So you're saying maybe 10%, 20%? What would you say?
Maybe for us it's like it remains very much controlled, but in the end I don't think it's going to impact the buying process and the appetite from the American consumer.
Who, Patrick, is your average customer right now? What's the average demo?
Yeah.
And I'm curious has that evolved at all over time?
It has evolved very significantly over the last 10 years. Probably the average age of our buyers went down almost 20 years in the last 10 years. So it's very significant.
What explains that? That's interesting.
It's first, the concept of I'm having a watch of a lifetime that I'm going to keep is evolving. I think consumer watch enthusiasts, especially the one that come to brand like Solana, are much more dynamic. They buy a watch, they buy another one. Some would trade, some will keep their watch, but they evolve very rapidly. And as I said, there is also a growing appetite for different brands. They want to discover. They start sometime with the Apple Watch, let's say, in a consumer journey, then go to mass luxury brands, and then they go to ideology. That's where we welcome them. And I think this is really shaping the watch industry in general, globally, but also in the US.
You mentioned the Apple Watch, and I know you were at Apple during that time. Talk to me about what that was like launching a smartwatch, and do you think that you see that market growing? Do you see you at least started getting into that market? What's the deal with that?
No, I think the smartwatch market overall was seen initially as could be seen as a threat to the watch industry. I don't think it is the case at all. I think it actually contributed to bring some consumer to wear a watch again, and to get something on their left or right wrist. And then little by little, they got more interest in different type of watches. And today, we see them collecting more watches. So the Apple Watch, I think, contributed to even the growth of the ideology market.
Patrick, I got to ask you, you're wearing that new watch right now, which is beautiful. I want that watch. How much is it going to cost me, Patrick?
This is going to cost you around $850,000.
That sounds like a deal. Yeah, it's mine.
It's almost sold out, so you have to order now.
That's one of 50, right?
It's one of 50.
But I heard can you show the camera?
Yeah, sure.
So I had heard that it starts at around 200,000 US, right? And then this is obviously a special edition with more different types of metals. And I know we've been talking about precious metal prices going up, right? That's part of your business too?
Yeah, well, in that case, what's very interesting? In the past, a luxury watch was actually a watch where you would have gold and precious material. Today, especially for a brand like us, it's about the movement and the complexity of the movement. Our promise to the watch lover is really, we're going to give you a movement which is so unique, and we're going to make it also with a limited edition. So we actually promise that there is a sense of exclusivity and also a lot of innovation, because that's what we stand for as a brand.
Consumers are growing more pessimistic about the economy in the year ahead. Deloitte's new holiday retail survey shows 57% of shoppers expect the economy to weaken in the next 6 months, the most negative outlook since Deloitte began tracking sentiment back in 1997. Joining me now is Mike Daher, Deloitte Vice Chair, U.S. Consumer Industry Leader. Mike, a pretty gloomy survey here. What's driving this level of pessimism, and how are we seeing that show up in some of that consumer behavior?
Well, that's right. This is one of the gloomier holiday outlooks that we've had in a long time, where spending peaked last year. It's down now and expect to be down 10% over last year, and that's showing up even more so in gifts and goods that people are planning to buy versus experiences. Although both will decline this year. Gifts will be well over double digits and buying goods over double digits, where experiences will be down around 7%.
Interesting.
So,
yeah, no, continue.
yeah, consumers are feeling affordability pinch at the moment, and various aspects of their overall wallet. We've seen a trend over the past year or so around value-seeking behavior, where consumers are going that extra mile to make sure they get a higher ROI on their personal spending. And that's showing up even more so this holiday season.
And Mike, tariffs have been a big overhang for retailers this season, adding to some of those cost pressures at a time when we are seeing consumers pulling back. So how are companies really balancing these higher input costs with the need to keep prices in check for those value-conscious consumers?
Right. So what's interesting in our research is we found that consumers, in their value-seeking behavior, 60% of it is related to price. And there are 40% of consumers' perception around value are things like quality, experience, trust, things that a lot of retailers can really continue to invest in to win over the consumer this holiday season. I'm especially bullish when it comes to small businesses, for example, during the holiday season that provide a unique experience for consumers, maybe an origin story that they can relate to, and consumers may be more willing to spend, with some of the smaller businesses. But all in all, consumers are expecting 77% of consumers are expecting higher prices this holiday season, and 57% of them are expecting the economy to weaken in the years ahead. And that's where we've saw the biggest jump in negative sentiment since 1997.
And we were talking to a guest earlier about how the higher income consumer is still spending aggressively. And maybe because of that, retailers could have a bit more wiggle room to raise prices. Do you agree with that? Or do you think we're approaching a pricing ceiling?
Well, certainly the higher income households, well over 200,000, have been sustaining over the past couple of years coming out of the pandemic. But even in our value-seeking research, we found that 25% of those households are starting value-seeking behavior. They're either holding back from buying altogether, looking for cheaper alternatives, waiting for more promotions to happen. We're seeing this holiday season, for example, people taking advantage of promotions that are happening this month in October ahead of the high holiday season coming up in a few weeks. But certainly lower income households are feeling the pinch the most and are planning to cut back.
Yeah, early shopping season is something we've been hearing from many folks across the board here. But Gen Z also stood out in this survey, cutting spending by 34% year over year while also using AI and social media to shop smarter. So what does that say when it comes to how retailers need to show up for these younger cohorts of buyers?
Well, that's right. We're seeing the biggest declines happening with Gen Z, followed by millennials. And then on the other end of the spectrum, a slight decline for baby boomers. Gen X are the generation to focus on this holiday season if you really want to drive margins. But for Gen Z and millennials, I would say know that they are tech savvy, right? They're using various Gen AI tools to not only come up with ideas for what they want to buy, but to find the best deal. So you need to show up in those environments because they will be deal hunting that way. Again, I would focus on broader perspective of value just beyond just price, and look at ways to connect with that consumer, build trust with them, provide a great customer experience. And all of our research shows that brands that do that, which we call more value for price brands, are outperforming those brands that lag behind in a more holistic value story.
So given that, which brands or retailers are really best positioned in this environment, have really all those positive catalysts going for them now?
Well, there's certainly variable within different segments of retail. But I think we all know that some that are provide great digital experiences for their consumers, a great service level within the store, that personal touch where you just feel the attitude is what the term we use of the employees and showing up to their consumers with a smile during the holiday season. All of that matters. A seamless omni-channel experience from their phone to the store. Easy returns are highly valued as well. So it really varies across the spectrum. But we've been studying the value-seeking consumer and saw this trend where there is kind of a split between the more value for price brands and those that provide less value for price. And the financial performance of those brands really outweigh, the more value for price outweigh the lower value for price.
Yeah, and the bifurcated consumer story continues. Mike, thank you so much. Appreciate it.
Thank you. Happy holidays. All right, thank you. Take care.
On Thursday, a pair of fraud headlines from regional banks spooked the markets. Long-term U.S. interest rates fell below 4% for the first time since April. Lower rates are good for borrowers, but then why does that sometimes give stocks a headache? And for that matter, why do rates surging higher also give stocks a problem at times? On today's Stocks in Translation, we are going to decode the signals from the fickle bond market to tell you why stocks seem to like Goldilocks interest rates. Not too hot, not too cold, and not too volatile. Let's start out with the 10-year U.S. Treasury yield. It's Uncle Sam's interest rate for borrowing 10 years out, and it's the benchmark that guides longer-term U.S. consumer rates, like for mortgages. And it's important to remember that bond prices move opposite their yield or rate. So when investors scramble for bonds in a panic, bidding them up, that's actually moving their yields down. Here is your cheat sheet on how the bond market wags the stock market. When rates climb too high, that raises borrowing costs, which can cause consumer buying on credit to slow down. It also makes some of the companies unprofitable. But if rates drop too low, that can be a signal that investors are rushing into the safety of bonds, thinking that the economy is slowing down. A classic growth scare signal. Most importantly, it's usually not the level of interest rates that matters. It's how fast they are getting there. A quick move to the upside or the downside triggers big institutions to cut down their risk, and stocks automatically get sold. That's the feedback loop. Now, let's review events in the recent past from a volatility perspective. Here we're showing a 1-month history of the VIX Volatility Index, VIX, which is calculated from stock options going out 30 days into the future on the S&P 500. This is where you see footprints of big institutions, and when it surges higher, stocks tend to sell off. Now, towards the right, you're going to see 2 spikes higher. The first was on October 10th, when President Trump threatened new tariffs on China. While stocks shot higher on Monday, the VIX didn't pull back that much, and it stayed elevated. So the market was primed for another shock, which we got on Thursday, October 16th. That was when 2 smallish regional Fed banks or regional banks disclosed an ongoing fraud investigation. Not cataclysmic, but with big investors already on alert, the VIX spiked a bit higher into the mid-20s. Now let's check out the same time frame with the bond market's volatility index, which is called the ICE B of A Move Index. Its ticker on the Yahoo Finance site is MOVE. You're going to notice similar movements in reaction to the 2 scares, but not as extreme as the VIX. In fact, Thursday's spike up took it to the same level as the prior Friday's. This happened as the 10-year yield dropped under 4% for the first time since April. And putting it all together, this suggests that the bond market wasn't quite as reactive as the stock market. So big institutions were not forced to mechanically dump stocks, at least in panic mode. Translation, this last week is not yet signaling any big change in economic conditions, but markets are more primed for future scares. Think of it as a ratcheting effect. So bringing it home, here's what to watch next in this saga. First, we want to watch the market's volatility gauges, the VIX for stocks and the MOVE index for bonds. Are they cooling off or are they staying elevated? Are they ratcheting up or are they ratcheting down? Then you want to watch the US 10-year yield. We already climbed back over 4%, which suggests that the scare over bank fraud was a little bit overdone. But remember that volatility is more important than the actual levels. Then, be on alert for any more negative credit headlines, whether bank fraud or simply consumers defaulting more on auto loans or mortgages. Surprises ratchet up tensions, which weigh on stocks. And finally, listen to what Fed officials say. They tend to be very careful and measure their words. But if the read-through is growth scare as opposed to soft landing, markets are going to get jittery. Bottom line, as long as things don't move too quickly, the risk rally with stocks pushing up against all-time highs should continue, but there is a breaking point, and that's what we're trying to gauge. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Leasing activity in Manhattan surged to 8.36 million square feet in Q3. That's more than 50% above the five-year average. Availability also fell to its lowest level since 2020, with tech, finance, and professional services driving demand. Joining me now is John Marr, Vice Chairman at CBRE, to talk about what the New York City office market is signaling for the broader return to office trend. John, thank you for being here. Super interesting survey, and we are seeing leasing activity run 40% higher year over year. What's behind this momentum? Is it really just all about these tech companies, the big banks, drawing people back to the office?
Well, thanks for having me. The stats are pretty impressive, and they've imply or show what we've been seeing for the last couple of years. The big surges in large financial services tenants and the law firms behind them. It's only been recently that the tech companies have started to come back. So the tenant activity is quite diverse and broad-based, and as we run into less and less space, we are starting to see tenants really get out in front of it and get out into the market to lease.
Can you just provide some context to us about the pandemic times and how much things have changed? I mean, wasn't that long, 6 years ago, 5 years ago at this point? And to see the resurgence, that's pretty amazing.
It's not amazing to me because I've seen this happen over the years where we've had one event after another and everything is going to change.
It's not unprecedented.
Right?
Yeah.
But it was, quite astonishing how broad-based that was. And even people in industries that you would not have thought would have hybrid work or remote work were doing it. Many people thought that was going to be the trend of the future. I think there were a lot of us that just thought it was temporary. It lasted a lot longer than anyone expected. Now, we don't even hear the word RTO anymore, quite frankly, but for a few handful of tenants.
So we often say, as New York goes, possibly the rest of the nation, and maybe I'm biased because I live here, but how much does New York City's office come back? Tell a story of maybe what we could see for other major cities around the country.
Well, I would say the office comeback is not, in every market around the country. New York City is unique, as we all like to know, tell people. The gateway cities are really starting to see the resurgence of some of the more traditional industries like financial services and law firms. And tech is starting to move back. And in fact, if we talk about the tale of two cities, how the better part of the market here is performing extremely well. On the other hand, there's a whole segment of the market that is quite soft. We see that in other cities as well. If you're looking for high quality space in San Francisco, Chicago, Boston, it's difficult to find. But if you want commodity space, it's still plenty.
So where are those cities that are similar to New York? My mind goes to like in Miami, for example, which has been, embracing crypto and tech.
Yeah, well, look, the reality is in a place like Miami, there's only 20 million square feet of office space. And while it's a nice market, it really is nothing. There's no influence that New York City has on Miami in any meaningful way. But large markets like San Francisco and Chicago and Dallas is actually quite active right now. But let's not forget, we have more vacant space in New York City than many of these markets have total inventory.
So let's talk price. The average asking rent holding around $77 per square foot, essentially flat year over year. Is it still cheaper to sign a lease today compared to pre-pandemic times?
Well, these average asking rents that we produce, the statistics are a lot more complicated because we have in 20% of the buildings actually have about 70% of the vacancy, right? So the vacancy in these office buildings are actually overweighed and therefore bring the prices down. For the kinds of tenants that are looking for high quality space in good neighborhoods like 6th Avenue, Park Avenue, around Grand Central, we're seeing deals well over $100 a foot. In fact, this is the first year where we've had deals outpace last year. We've had 143 deals so far over $100 a foot. And a third of those deals are over $150 a foot. And what's really interesting is that we used to look at the market. The high-end market was $100 rents, and we'd watch the $100 rents, and now we're starting to see $150 rents,
wow.
$200
so
rents,
those
and even
amenity
$300
buildings
rents.
And those good locations, they're really outperforming
really
and
high,
boosting, I guess, the average.
Yes, really high-quality space. In the years that I've been doing this, we often talk to our clients about the importance of high quality space in good buildings to recruit and retain talent, right? But I've never really seen the tenants actually lean into it the way we're seeing now, to design space purposely to recruit people, retain them, to have productivity, to have engagement. So these people come in well before 8 and they don't leave, well after 6. There's no RTO in that conversation.
Interesting. And real quickly here, but this is something we were discussing in our morning meeting this morning about how a lot of these commercial buildings were being turned into rentals. Has that trend stopped at this point as there's more returning to office?
Well, when you say rentals, you mean residential.
Right.
Residential
communities.
Look, there are about 25% of the vacancy in our market is kind of ghost buildings that are very challenged. Either the buildings themselves are obsolete, or the capital of stack in the building is a mess. The values are difficult to understand. So everybody is looking at that. And some of them make sense. They're very expensive to convert, and sometimes they just don't work physically. It's meaningful in terms of the improvement to housing, but it's not meaningful in terms of the stats to office space. We have 420 million square feet of office space, and maybe 7 million square feet of it has been converted to residential. Everybody's looking at it, but it doesn't always make sense.
All right, John, super interesting stuff. Appreciate you stopping by today.
Okay, thank you.
Well, that's it for Market Catalyst. I'm Allie Canal. Thank you so much for watching. More Yahoo Finance straight ahead.